Hi, let's discuss about dividend theory, Gordon's model. Let's discuss about the assumptions, valuation, optimum payout ratio, and criticisms of the Gordon's model. The first and most important assumption is the company is completely an equity firm. The company does not depend upon any outsider's fund for financing the assets. That's actually the first assumption. And second assumption is there is no external financing, only internal method of financing has been used for financing the assets. That is second assumption. Third assumption is company's return is almost constant and the cost of capital is also constant. It's not fluctuating, it's not variable in nature. And the earnings are also perpetual in nature and there is no tax and the retention ratio is also constant in nature. Then the last assumption is the cost of capital is greater than the growth rate. Based on all these assumptions, this model is working out. This is Gordon's model. Market value of share is equal to the present value of infinite stream of dividend to be received by the shareholders. That's the value of the share. So there is a formula that used to calculate the value of the share. P equals EPS into 1 minus B divided by K minus BR. This is the formula to calculate the value of the share. So let's look into the things. Rate of return is given. What is R? R is known as rate of return, 0.15, 0.10 and 0.08. What is K? K is known as cost of capital, 0.10. And EPS is also given 10 rupees. B equals 60%. B is known as retention ratio, that is 60%. Then let's look into the formula. This is the formula EPS into 1 minus B divided by K minus BR. So you can apply this formula here. 1 minus 0.6, 60% is the retention ratio. So 0.6 whole divided by 0.10, that is K minus R is 0.15, 0.15 into this 60%, 0.6. So you will get market price of share 400. If you substitute the items in the formula, you will get 400. And P equals, just like that, you can apply 1 minus 0.6 whole divided by 0.10 minus this rate of return 0.10 into 0.6 equals rupees 100. So you will get that. And third one also you will get like that, 10 into 1 minus 0.6 whole divided by 0.10 minus 0.08 into 0.6. So you will get 77 rupees. So different values you are getting. The first one is 400, second one is 100, third one is 77. So what you can understand from that, if the rate of return is greater than the cost of capital, then the retention ratio at high level, then the market price will be at a higher price. So if the retention ratio is actually 60%, rate of return is only 0.08 and cost of capital is 0.10, which means that rate of return is lower than the cost of capital. What happens to the price of the share? Price of the share is very low. This is what you can understand from this model. So what are the findings from this model? All growth firms should retain their earnings for maximizing the market price of the share. All normal firms must distribute their earnings as dividend to the shareholders for maximizing the share price. And declining firms, there is no effect for the declining firm. So the argument put forward by Krishman is investors are risk averters. They always consider that distant dividends are less certain than the near dividends. So definitely you want to apply the time value of money concept for calculating the value of share. And the last model is known as Modi-Miller model. According to Modi-Miller model, dividend policy of the firm is irrelevant. It does not affect on the value of the firm. They always argue that value of the firms depends on firm's earnings, which is resulting from the investment policy. Modi Miller always argued that dividend policy does not have any relevance on the value of the firm's investments. If you invest in good assets will give maximum returns that will maximize the value of the shares. And if you collect the funds at a lower rate of interest from any banks, then it will maximize the value of the share. That is the approach of Modi Miller. Dividend decisions and dividend policy does not have any influence on the value of the share. That is Modi Miller's approach. So these are the basic theories. First one is Walter's model, second one is Gordon's model, and third one is Modi Miller model. And first two theories tells that dividend policy has some influence on the value of the firm, Gordon and Walter's model. But Modi Miller tells that dividend policy has no influence on the value of the firm. Thank you. That's all.